What a real privilege, actually, to be on the stage with all of you. I wanted to start by setting a little bit of a scene. Four powerhouse women walk into a bar, and they all happen to be investors of different types. And we're going to have a conversation around drinks of whatever you're kind of drinking today, about climate change, and about how we can really flex the muscle to do more, to address climate. And from the practitioner's perspective, each of you are practitioners in your own right, and you do different types of investing, and you have different backgrounds in investing. And I wanted to get each of you to go around, introduce yourself for the audience, maybe in that introduction, the context of what type of investor you are, and then maybe tell us how you think you can start to flex the muscle as an investor to address climate change, or what more needs to be done. I'll start with you, Lauren.
Okay, great. Can you hear me as well? Okay, great. Even better. Yes, I'm Lauren Faber O'Connor. I'm an operating partner at Lower Carbon Capital, and I'll tell you a bit of what Lower Carbon Capital is and the sort of ethos of Lower Carbon in a moment. But I'll just say that when I think about our role as venture capital, which is very early stage to begin with, seed dollars to help a great idea grow into a company. I think of our position in the market as really from the innovation moment, that spark, to scale. And what I really appreciate about being in this space is I'm coming from almost 20 years in the public sector, mostly in government. And this was a moment, I wanted to move into VC, I'd say, for a couple reasons. One is despite not having been in finance previously, I felt like I could very much intuit and forecast where the market was going, because I'd been a part of a lot of the policies that were being developed to create those markets. And then as a practitioner, previously, my most recent role before coming to Lower Carbon was as the Chief Sustainability Officer for the City of Los Angeles. And so that was really as a customer and operationalizing decarbonization across all kinds of infrastructure. And so, wanted to then, and that a few years ago, really see how the policy environment and the corporate kind of commitment, and certainly on the city municipal side, commitment to go net zero, to adopt solutions, that came together in a forceful way that I'd never experienced in my career. It was very optimistic to see that happen. And so it was an opportunity to move from one space to now really being able to facilitate innovation and help that innovation find its markets, all the former me's of the world. And so at Lower Carbon, I think our thesis, our central thesis, is sort of what the Rev was saying yesterday about this community, and maybe 100 million, or even if we're being generous, 200 million people on the planet are probably willing to pay more, use less, turn off the AC in their car to preserve their EV battery, to, save on emissions from gas and not turn on their heat. Like there is a percentage of us willing to do that. But that only goes so far. And so we want to be in the business of bringing solutions to everybody. So, because we believe that climate solutions are better, faster, cheaper, more delicious, cozier, higher quality, and ultimately save money and make people money. And so in Lower Carbon, as investors in early stage climate tech startups, we think about climate tech as really everything. That is in renewable energy, in transportation, critical minerals, in regenerative agriculture and food systems, in industrial materials across the supply chain. And so venture dollars are really a spark for those types of innovations. But it doesn't stop there. And that's why we're all gathered here, is because climate solutions are are capital intensive. We have to build stuff. We don't drive a cloud. We don't eat a cloud. Like, we have to build the things that are going to be the assets that power our economy. And that takes different kinds of dollars that are willing to spend big on capital intensive, that are really going to take the things that we're investing in to scale.
Great, and I want to come back to this when we come back. But Chante, maybe talk to us about how you think about flexing the muscle in terms of being an investor in this space.
Yeah, well, I'll start and just update that it's 5 women that are investors, including you, Stacy, walking into the bar. And I'm picturing an Aperol Spritz, because that's what I would love to drink right now. So hi, Chante Harris, founder and managing partner of Eunoia Group. I've been a climate tech investor, operator, and advisor for about a decade now. Started out doing a lot of what Lauren alluded to, actually working with different stages of companies. So think the largest fleet manufacturer in the world for EVs, leading hydrogen fuel cell electric vehicle charging companies, anaerobic digestion companies, just sort of the whole shebang across a lot of different categories and climate. And what I realized really quickly as I was scaling these companies was how important this capital stack that I think we're all here to talk about today is, right? So it's not just venture capital, as Lauren was speaking to, it's growth equity, it's debt, it's non-dilutive capital. And so a lot of the work that I started out doing was, how do you actually get that first commercial plant or facility or even pilot project off the ground? And certainly VC plays a role in that, but it's not just VC alone that allows for these things to ultimately start and then reach completion. So I did that work for a while and was really interested in how to close the gap for the early stage investment conversation. So started and ran a $10 million venture studio model aimed at de-risking early stage climate technology companies. And I'm mentioning this because what happened, particularly over the past few years, is we saw early stage investment in, climate technologies increase significantly. So $70 billion globally was deployed into climate technologies in 2022 alone, And so we've seen the number increase over time, which is super exciting because we're seeing a lot more solutions actually get to pilot and demonstration stage. But then when they get there, who finances their scalability, right, and their commercialization? And so I think that's where the opportunity lies when we talk about flexing capital, because it's not just where do you sit in terms of your asset management strategy, but how are you actually working with other asset managers to ensure that there's a pipeline of capital for your companies as you scale. And we need that now more than ever. And so Eunoia Group is a platform I launched last year out of a residency with Schmidt Futures. And our entire thesis is, let's make the great deployment happen, right? And how do we do that? So we use data analytics and investment strategies to think about multi-asset strategies for investment. And so just to give some examples, and I know we'll get into more of this later, it can look like a blended finance vehicle. So how do you take joint ventures and combine equity and debt so that you're unlocking working capital for asset-based lending of hard assets? Or it can look like, for philanthropic and catalytic folks, creating a catalytic impact program that is focused on funding the pre-development processes, or what I like to call the unsexy parts of climate technology deployment. Depends on who I'm talking to. I know there's probably some folks who are like, hey, this is sexy. Right, I know Lauren knows. But it's permitting, licensing, feasibility studies, community engagement even, right? So how are you actually ensuring that capital goes to those companies, but is also applied in the right area? So that's what we focus on, and we help build strategies and actually allocate that capital in partnership with individual and institutional investors. And I'm just really happy to report that in our first year, we were able to support Trellis Climate and their initial announcement around taking recoverable grants and applying that to pre-development capital. We also supported a private equity firm in creating its own credit arm so that they could invest through equity, but also credit for a lot of these hard assets that I was mentioning. And then we worked with a philanthropic entity that has $45 billion under management. Big, I want them to do climate a lot more, but they've already allocated tens of millions of dollars into climate with the intention to do more. And so what does that look like? Does it look like solely investing in venture? Does it look like investing in growth equity? Does it look like creating their own credit vehicle? And so these are all of the exciting questions, I think, in the ecosystem right now. And we're really focused on answering those questions, showing that we can innovate, and ultimately creating the templates so everyone else can do it.
Fabulous. Elizabeth, you are doing something super interesting at the nexus of investment and climate. Maybe talk a little bit about how you're flexing the muscle.
So I believe so much in philanthropic capital, of course, and government capital coming in and VC capital, but I feel that if we don't bring Wall Street into the equation, you're just not going to move the needle. And when I talk to Wall Street about food systems transformation, they have no, remember, we are in the bubble of the bubble of the bubble. They have no idea what we're talking about. They say, well, I went to Costco. What do you mean there's a food problem? So it was important to me to have a financial tool. I'm the CEO of VegTech Invest. We've created the only ETF, publicly traded, listed on the New York Stock Exchange, that focuses on sustainable food systems transformation, starting at the very beginning. So ag tech all the way up through the supply chain, ingredient suppliers, synthetic biology, flavor, texture, profile companies, and then, of course, consumer packaged goods at the end of the day. And we wanted to explain through this financial product, which gives people the opportunity to make money. So I go to Wall Street and dangle like, this is how you're going to make money. This is, come over here. I dangle the money so that I can explain food systems transformation, the entire supply chain, and what needs to happen, because 32% of the world's global methane emissions come from animal factories. If you don't address that 32% number, you're not going to change anything. 41% of the world's deforestation comes from animal grazing. So if you don't address those numbers, you're just not going to impact climate change. So the way that we explain it to Wall Street, in addition, once I've got their attention with, this is how you make money, here's a vehicle, invest in the ETF. ETFs are very simple. You've one-stop shop, one ticker, EAT, very easy to get in, get out, it's liquid, it doesn't take a lot of commitment. But this is the kind of impact you can have. So there are 37 companies in our ETF. We have a global temperature warming potential of 1.18 degrees, well below the Paris Accords. What's everybody investing in? S&P 500? That's where our planet's going, folks. 3.23. So that's where we are. And we explain to them that you can bring down the carbon footprint of your portfolio. So we try to make it in we are as educational as we are an opportunity to make money. We try to explain that getting in the ETF can have this kind of lowering of their carbon footprint. In addition, a study by the Boston Consulting Group said, well, if you were in the bubble, and you understood that you wanted to have sustainable capital making an impact, and you were to look at the green technologies possible, so you would look at building materials, electric vehicles, new energy, and diversified proteins. The latter, diversified proteins, would be 3 times to 40 times more impactful at reducing greenhouse gas emissions than the other green technologies. Obviously, we need them all. All hands on deck. All hands on deck, all capital on deck, all blended capital options. Obviously, we need it all. But the reason this is because the CapEx spend is a lot less, and so you can get your impact faster. So you scale up faster. So we focus, long story to say, we focus on food systems transformation on Wall Street in publicly traded markets with the EAT-V ETF. And, it's tough out there because there's been an attack politically on ESG, so we're hoping to get beyond the election.
Amen.
Amen, exactly. Lila, you are with one of the OG climate investment firms. Maybe talk about how you guys think about flexing the muscle to advance climate action.
I will, and I'll try to stitch some pieces together because you talked about public markets, we talked about early stage venture, and we talked about blended capital structures. And Generation, for context, was set up about 20 years ago, and I'm also in my 20th year, so not quite the first, but probably number 17. And we are a dedicated sustainable investment platform with over 40 billion of assets. We started in the public markets, and then we moved into the private markets. And I head today our growth equity fund, which is actually on our 4th fund. It's 1.7 billion. And we're really accelerating the transition to a more sustainable future. We combine climate with health and financial inclusion because we actually think that systems lens is really critical. I actually imagine all of us do this in the climate lens. It holistically includes inequality or addressing inequality and health outcomes. And I think there's actually food and sustainable food systems is one of the perfect places for this all to come together. About 5 years ago, as a partnership, we took stock of what we did in the first, sort of 18 years. and obviously large public, dedicated sustainable pool of capital, private growth, and then private equity. So we have a more significant size private equity practice as well. But we recognized that, Mother Nature didn't care. Like, she was not responding, and therefore we needed to do more. And so there was a series of conversations which really crystallized the launch of a new strategy for generation called Just Climate. And Just Climate is a dedicated pool of capital for climate-led investing. And here's where I'll go back to what Lauren and Chante were talking about. It's picking up on these great technologies that are coming through the venture ecosystem, sometimes through the impact investment ecosystem, and they've retired tech risk, and they have some level of product market fit, but they need capital to scale. And so what Just Climate set up was an industrial decarbonization fund, and then now a natural capital solution strategy, which is trying to decarbonize as fast as possible, looking for market rate returns, but comfortable with capital-intensive businesses. Now, that's just not something that everyone wants to tackle, and you have to build a team that's fit for purpose. You have to have engineers on staff. You have to have climate scientists. You have to have people who understand stakeholder engagement. It is a new set of skills, which we have across the finance industry, but you need to put them together to fill these gaps. And so I think actually that's probably, to throw back to the group, gap filling, and what it will take is a lot of innovation in finance, and finance hasn't been historically great at innovation.
Well, I'm going to pick up on that and then come back around, because that's such a good point. In addition to kind of making sure you have the right people around the table to have the ability to diligence and then invest around it, what are some of the ways that, where are some of the gaps in financing that you see kind of are missing out there that you wish were coming to the table? And I'll start with you, Lila, and come back this way.
Yeah, so it's interesting. The Growth Fund, we do invest behind companies that have hit 20 to 30 million of revenue. They're really scaling, but they're more capital light. And I love every 50 climate tech investments will get to that stage, and we want to be the partner to help them scale. So like back in the day, we started in 2008, Nest, Solar City, AgriQuest, companies like, O9 Solutions, Pivot Bio, like those ones, I think there is a kind of conveyor belt of capital where there are handoffs and partners who know how to scale those businesses. What gets stuck is where you need to build things, oftentimes with first of its kind technology or less familiar technology to the capital markets. And there are great groups like the banks, obviously even before that, groups like Vision Ridge or Generate, who can take, the second to the fifth site, but you need someone to do site, first of its kind, site 1, site 2. So that's one that I would highlight. And maybe, we're the venture crew, they need to know who's there and what they're looking for, what are their milestones, and then what will an entrepreneur need to show up with in their deck for that series, B to C.
Yeah. And then maybe I'll ask you, Elysabeth, to kind of respond to that. But also, Chante, you were talking yesterday when we were prepping about the role of blended capital, and you brought it up again. So maybe when we come to you, you can talk about that in this context as well.
I'll respond and also say maybe that it's a little frustrating in that, I'll just grab the button. Oh, great, it's working. The World Bank says that food tech is climate tech, and yet you look at the amount of money being spent on new energy. I believe it's $2 trillion. I say this from my podcast with the New York Stock Exchange. The senior energy analyst for Bloomberg Intelligence says it's $2 trillion that was spent to date. And you look at what's being spent on food systems transformation, which impacts health, healthcare costs, pandemic risk, antimicrobial resistance, food security, which is a question of national security, water, land use, climate change, deforestation. You look at this holistic perspective, it's getting in the billions. Still, our problem is money, period. I'd like to see more government money, more philanthropic money, more, Wall Street money, more VC money. And that's just, so the education, the money, and the money to scale the infrastructure. A lot of the things that happen in food, we already know, fermentation. But we've been fermenting insulin. If anyone here takes insulin or they know people, we've been fermenting insulin instead of from factory farmed pigs. We fermented in pharmaceutical grade. We know how to do this. You can ferment proteins. We know this. We're just not funding it at all. It makes no sense.
Yes. Maybe Chante and Lauren, the role of public capital or patient capital and why it's so valuable from a blended finance perspective from where you are to get to where they are.
Yeah, so we focus on the space between $20 million and $100 million. So $100 million being that, area where project financiers tend to jump in. Many of the companies that I've seen need somewhere between $20 and $100 million. So that's that significant gap that we're solving for. And I mention that because when we we think about blended finance, what we've been uncovering, and it's not just us, again, I mentioned Prime Coalition, Accelerator's been doing a lot of great work in this space. Where can catalytic capital actually play a big role? And our thesis personally, and folks may not agree fully with this, I think we're open to updating it as we all learn together, is that catalytic capital can actually have a huge impact in that $5 million to $20 million range, where you're really thinking about pre-development processes, where you can use venture capital money, but is it actually the best use of VC? No. And so we've been really focused on how can we work with philanthropic entities, consortiums of family offices, to see how they can both aggregate or take their capital and deploy it to those spaces. Because just to give you a concrete example, we were working with a consortium last year, and one of the things that came up almost consistently was that, $2 million, $3 million that were deployed to companies that quite frankly had never done this before. First of a kind means that those companies are also doing it for the first time, which means they may not hire the right staff. They may not actually approach it in the right way. And so we saw a few case studies where $2 million was, quite frankly, wasted on the pre-development process because they didn't employ the right tactics. And a lot of this stuff is proven. So I think it's really about, let's increase that capital, but let's also increase the knowledge, the appropriate skill set, right, in the investor and in the investor and innovator community, so that we're not wasting the money that's being deployed. And then the other thing I'll mention is, I'm sure many of you have heard of S2G Ventures and what they're doing with creative capital. I think when we talk about blended finance, it's not just where do you play a role, but how are you also collaborating with other folks, right, who will follow on, who will be co-investment. And so when we think about institutional investors, we're essentially working with them to say, hey, you don't have to do it all, but let's ensure that you understand what your strategic approach is in the ecosystem, and you have the right partners, so we don't stop at risk and go, oh, this is too capital intensive, or we really only focus on technical risk at this stage, because we know that, one, that's not working, but also the exciting part is unlocking that opportunity. We're supposed to see a rise of $3.2 trillion in real assets. And so we're going to see it increase in total to over $9 trillion annually. So you want to be a part, right, of that upside. And that's really been our approach to the ecosystem.
Tough to think about where to go after all these fantastic comments with the little time we have. But I would say that to address some of the gaps that we're seeing in moving from demonstration, where I think venture dollars are able to kind of carry it to a point. And I don't know if folks in the audience were like me, but a lot of these are new words to me. And finance is like a whole other vocabulary. And it's fantastic and hilarious to talk to some of my government friends who just are like, wow, you like talking a whole new language. And these are difficult to understand, yet relatively simple terms. But when venture dollars are investing in having equity in a company to help them build their, literally hire people, build their business plans, start to do their work for us, even like plucking best ideas out of a lab, and get up and going with de-risking their technology and testing and developing out the technology. We have early equity in that company, but they're not always looking to further and further dilute their equity as founders or as other early employees in the company. And so non-dilutive capital, which can come in the form of government grants, it can come in the form of loans, that can come from many different sources, or a little bit more of sort of concessionary capital that is able to be willing to be kind of first loss, that can bring in and crowd in other more conventional forms of capital. Because these are very kind of capital intensive efforts where you can't sort of do a software tweak overnight if something didn't go right. It's harder to find that kind of community of in the capital stack that is willing to go in early. And we want to de-risk a first of a kind. The first time you've ever, you've ever produced steel at room temperature. Well, we're seeing it happen, and we have to build it at commercial scale in order to be able to compete in the market at commercial rates. But it hasn't been done at commercial scale. And so to have to repeat it over and over to fit into the existing kind of financial structure and practices that we're used to, we don't really have time for that. And so who are the partners who are willing to collaborate and think early with across the capital stack that are willing to dive in? And that may require more coordination with the public sector. It may require more coordination with the philanthropic side. And I think that would be great, but it's a very new and budding area that a lot of us are trying to dive into deeply.
Okay, so can you hear me now? Okay, so we don't have that much time, a lightning round. And when we prepped, I said the last question would be, what more do we need to do? But I'm going to put in a little context. You all are working in areas that are somewhat demonstrating to the rest of the financial sector how it's done. What would be the two things, not three, not one, the two things that you would want other investors to do to move the entire financial system towards climate action? If you think there's $16 trillion in the top 10 systemically important financial institutions in the United States, that's trillions, multiple trillions, and we've got about couple billion on the stage here. What do you do? What are the two things you might say to do? And we'll go this way.
Sure. I think early coordination and being willing to kind of think together about investment strategies would be really exciting. And maybe one of those think new and different ideas. I also think that investment in workforce is really important. We are building massive amounts of infrastructure and going to be needing and upskilling a ton of workers, which is super exciting for our economic development. But that upskilling needs to happen quickly in order for those climate solutions to be able to do the work to scale.
Yeah, I'll just say standardize, and then old tools, but novel applications. Mm-hmm.
Courageous leadership emboldened with education. So what I'm seeing is a lot of, where's the profit? I'm not going to seek to understand. I'm not going to look where there are gaps or white spaces. I'm not even going to look where I could make money. I mean, it's like laziness at its most extreme. I'm just going to go with what my next door neighbor's doing to make money. So it's lacking of leadership, lacking of willingness to educate.
Yeah,
be
I'll just
educated.
talk about the journey in I might be out now. The journey in the first cycle of kind of clean tech boom bust, which was a tough period to go through because everyone was very optimistic until they went to raise the next round and they hadn't educated along the way. And so I actually keep reminding entrepreneurs, again, we might not be investing in them through the growth team, but maybe it's through our Just Climate strategy, to think ahead and think about the milestones you'll share and start educating your potential future investors sooner rather than later so that you don't get to that point where you need the capital and it's not there. So that's number one. And number two is governance, because governance matters in every aspect of investing in every region at every stage. And I think if people have disproportionate voice or you don't have the right representation around the room, companies will suffer and not scale.
And on that note, I would answer the question with one thing, that we should clone these four amazing female investors to multiply them throughout the financial sector, because it's women like you who are going to make a difference. So join me in saying thank you for these lovely people on the panel.
That was fun.